Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, massive run up in tech, massive run up in the stock market, but it's all going to end in tears. And the reason for that is in this video. So let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. All right, Bob. So the bullish fever here is just at a record pitch, and everyone online is just saying bears are toast and all this other stuff. But, and there's a big but, this happens in every bear market, doesn't it?
Yes, what's interesting here is that, we didn't know if we were going to fall straight off a cliff or we were going to have a crack up boom. But the problem we had this time, Phil, is that only one sector got the memo, and that was tech. All the other sectors are acting like you would normally expect in a bear market. But look at this chart of the inflows for tech. I mean, Never before we've seen inflows like this. People are racing in. And I think, this is probably another social media phenomenon where people react so quickly now to news that I think we're going to see more of this. And, as the tide goes in, the tide's going to come out. This is absolutely unsustainable. And we'll show you a chart in a second to show you why. And so, before I get to the next chart, I'd like to get your thoughts. I've not seen this in 2000. And when basically in 2000, the whole market was going up because everybody was looking for the Y2K catalyst. For people who didn't trade back then, there was a reason why there was a lot of tech spending, because there was a lot of tech spending. People were converting systems over. They're buying brand new hardware, networking gear. They're buying new switches, new routers, new software. I mean, people were spending a lot of money, so much money, in fact, that our budget deficit went away in the year 2000. And in 2008 was a different animal because it was really it was commodity and it was real estate related, and once again you had this massive move in one sector that caused the whole sectors to crash. And now we have this whole rally is tech and tech only. What are your thoughts on that?
Yeah, the breadth is really bad here. The lags in the other sectors, Russell, for example, been really terrible. But the thing you guys have to understand too is if you look at this inflow, right, it's just completely gone past what we saw in 2021, which was just a full-on bull party for tech. And here we are, tech's at a lower high, and yet look at these inflows surging back in. And this is, the inflows of this size are dwarfing anything that we've seen in the past, even in bull markets. So the question is, well, why? Well, you have to remember too that bear markets tend to have multi-month rallies, okay? And I propose that the reason why the inflows are as high as they are is because this is part of like the squeeze and the FOMO that happens. You get the squeeze and the people pile in because they think it's a new bull market. And the reason why the inflows are so high is because we've had a record amount of liquidity that still has yet to come out of the system. If you guys, those of you that have gotten the Fed liquidity chart, if you zoom out, you'll see that we have only put a dent in the amount of liquidity that was pumped in from the COVID pandemic, where the Fed basically panicked and infused the entire system with artificial liquidity, right? Huge amounts of it that we've never seen before. 2 trillion. And so that's why this spike is so high, Bob, in my opinion. And the problem here, though, is going to be that once the effects of the short squeeze are done, what you have is people that have come in at the top here, and the underlying driver of the markets is ultimately the economy. And as you know, this economy is now at stall speed here.
Yeah, and Phil, I think the other thing that people don't realize, in 2000 and to a lesser extent 2008, people weren't just jamming options like they are today. People have pretty much abandoned buying stocks, and people have just been throwing in call options at this,
Right.
And that's fast. That is fast money, because there's a time duration to options, and and I guarantee you, people aren't out there a year on call options on Nvidia, right? They're doing it a week at a time to get to get that squeeze continuing. But look at this next chart. This is what's called a Sornet wave. Okay, that the French philosopher. It means that you can't get the angle can't get any steeper. I don't think, Phil.
Yeah.
And is it going to keep blowing up? But we saw some charts. I wish I would have thrown a chart over to you, but you're starting to see these weekly blow off. Island tops on and shooting stars on a lot of these names now, and so all you have to do is catch a weak gap down, and
Yep.
everybody and their brother that's buying calls is going to be literally wiped out. And
Yep.
when they're wiped out, all the market makers do is sell their futures contracts, and this thing's over. I think the last time we had a move like this, 3 months worth of gains was gone in 5 days.
Yep.
Just to give people perspective. So people wonder why we're badgering us. Look, I rather wait to have this thing sell off before I would want to buy anything, because you never know what day the trigger is going to hit, and
Yep.
why be stupid with your money?
Yep, I agree. And that, rising wedges is pretty bearish in the stock markets. This one is how steep this is even more bearish. So you could easily see, where where those orange lines are depicting a wedge pattern. I mean, you could easily see that half of that retrace back down in a day or two. I mean, that's the kind of situation that we're in here. So yeah, I agree with you, Bob. Extremely risky here with because it is a blow off right now.
Yeah, and just people know too, the chart patterns I think that have the highest reliability are the wedges. Rising wedge and falling wedges are usually very, very reliable. They're very mathematical, and so I could see a third coming off this thing in a week, in a minute, no problem.
Yeah, and the angle I think is also important too. And the steeper the angle, the greater the chance that the pullback is more severe. So I agree. Got to be very cautious here, gang. So
yep. So sorry, guys, no bullish themed podcast today. Maybe when the market's down 40%, we can get our patch back on. So. If you like the video, give us a thumbs up, like it, notify, subscribe, and just check us out every day. We're trying to be very consistent on when we put these out, so we don't have to rely on the YouTube algorithm to inform you that we've created another podcast. 6 days a week, whether we're on vacation or not, we put these things out for you guys. That is our dedication to you. Have a great day.
All right, guys. See you later. Bye.
Trade Genius.